What if the next market crash doesn't begin with panic, but with excitement? And the shocking truth is that some of the biggest financial collapses in history actually started when investors felt safest and most confident. Markets often hit new highs right before major downturns, which tricks people into believing risk has disappeared when in reality it's silently building underneath the surface. The same early warning patterns that appeared before past crashes are quietly forming again in ways most people don't even notice yet. Welcome to U.S. Finance Insights, where we break down money, markets, and future trends in a simple and real way. And if you like learning how money really moves, consider liking and subscribing so you stay ahead of trends before they become headlines. Because today we're not talking about fear or hype, we're talking about real signals that historically appear before major market drops and how you can recognize them calmly without panic or guesswork. Here's something most investors misunderstand. Crashes don't begin with chaos. They begin with quiet shifts that look harmless at first glance. Those shifts often show up in economic behavior long before they appear in stock prices, which means by the time news breaks, it's usually already too late to react intelligently. Everyone could clearly see a crash coming. It wouldn't crash at all because markets would adjust slowly instead. Real warning signs must be subtle, otherwise they wouldn't work as signals. So the real question becomes, what exactly are those signals professionals watch while most people ignore them? The answer starts with earnings trends because corporate profits are the engine that drives stock valuations whether investors realize it or not. When earnings are growing steadily, markets have fuel to rise, but when earnings growth slows even slightly, the fuel supply starts shrinking. Here's the twist. Prices can still rise for months even after earnings momentum weakens, which creates a dangerous illusion of strength. Many investors get trapped because they assume rising prices mean strong fundamentals, when sometimes they actually mean the opposite. Late-stage rallies are often driven more by optimism than performance, and that makes them fragile. Markets are forward-looking systems. Investors price in expectations about the future, not just current conditions. So when expectations are high, stocks can stay elevated even if real business performance starts slowing. Eventually, reality catches up, and when it does, prices adjust quickly, sometimes violently. What matters more isn't current profits, it's future expectations, because markets move based on what they think will happen next. Now let's talk about liquidity, one of the most underestimated crash indicators of all. Liquidity simply means how easily money flows through the financial system, but its impact is massive. When liquidity is abundant, investors can borrow easily, spend freely, and take bigger risks, which pushes asset prices higher across the board. But when liquidity tightens even slightly, borrowing slows, risk appetite drops, and prices lose support. Think of liquidity like water pressure in a pipe system. When pressure is high, everything flows smoothly, but when pressure drops, even strong pipes struggle to deliver. Liquidity can tighten long before investors notice visible changes in markets, which makes it one of the earliest warning signals available. Many downturns were preceded by gradual liquidity reductions rather than sudden shocks. Those reductions often come from policy decisions, especially interest rate changes. When rates rise, borrowing costs increase, which slows spending, expansion, and investment activity across the economy. Companies delay projects, consumers reduce large purchases, and speculative investments become less attractive. But markets don't always react immediately to rising rates. Sometimes they keep rallying for months, which convinces investors that higher rates don't matter. That delayed reaction is exactly what creates risk because it builds complacency. Complacency encourages leverage, overconfidence, and concentration in popular trades. Concentration risk is another overlooked crash signal. When too much money crowds into the same assets, it creates imbalance, which makes markets more fragile even if prices are rising. Imagine a bridge carrying far more weight on one side than the other. It might look stable until suddenly it isn't. Credit conditions provide another early clue. Lenders analyze risk constantly, and when they start tightening standards or demanding higher premiums, it usually means they see rising uncertainty ahead. Credit markets are typically less emotional than stock markets, which makes their signals more grounded in reality. When credit spreads widen or loan approvals decline, it's often an early indication that financial stress is building quietly. So why don't most investors watch these indicators if they're so powerful? The answer comes down to psychology. Humans naturally focus on visible price movement because it's exciting, immediate, and easy to understand. Underlying indicators require patience, interpretation, and discipline, which most people don't practice consistently. That difference in attention is exactly why experienced investors gain an edge. They watch what others overlook. Volatility, for example, often stays unusually low near market peaks, which creates a false sense of stability. When prices move smoothly, investors assume risk is low, even though historically low volatility can signal complacency instead of safety. This is why professionals sometimes become more cautious when markets look calm, not less. Calm conditions can mean risk is quietly accumulating beneath the surface, like pressure building inside a sealed container. No single indicator predicts crashes perfectly on its own. Real warnings appear when multiple factors shift at the same time. When earnings momentum slows, liquidity tightens, policy becomes restrictive, and credit conditions weaken together, they form a pattern that has historically preceded downturns. Recognizing that pattern is less about prediction and more about awareness. Prediction tries to guess exact timing, while awareness monitors risk conditions continuously. Awareness is far more reliable because markets can stay irrational longer than people expect. The smartest investors don't try to forecast crashes precisely. Instead, they track whether conditions are becoming stronger or weaker over time. If conditions strengthen, they stay invested confidently. If conditions weaken, they gradually reduce risk exposure. This approach removes emotion from decision-making because it's based on observation rather than reaction. Avoiding large losses is often more important than chasing large gains. Losing 50% requires a 100% gain just to recover, which is why risk management matters so much. Understanding signals only matters if you can apply them to the future. The next major downturn, whenever it arrives, will likely follow a familiar pattern because human behavior repeats consistently. Optimism will rise, risk will increase, warnings will be dismissed, and then sentiment will suddenly change. When sentiment shifts, markets can fall much faster than they rose, which catches unprepared investors off guard. The goal is not to fear crashes. The goal is to recognize when conditions suggest caution so you can act early, calmly, and strategically, instead of reacting emotionally after prices fall. By the time panic appears, most of the damage has already happened. Informed investors listen to quiet signals, while reactive investors respond to loud headlines. So the real question isn't whether markets will crash someday, because they always do eventually. The real question is whether you'll recognize the warning signs before the crowd does. Markets whisper before they scream, and those whispers appear in earnings trends, liquidity shifts, policy direction, and credit conditions, long before price charts confirm anything. Do you think most investors pay attention to real indicators, or just follow headlines and hype? Share your opinion below and send this to someone who wants to understand markets on a deeper level. This is U.S. Finance Insights, reminding you that smart money decisions today can change your tomorrow.